You think the economy is getting better and your bank account is safe, but the reality is you are quietly getting absolutely crushed by inflation and market fear, while Wall Street elites laugh all the way to the bank if you are tired of watching your hard-earned money slowly melt away, while tech stocks experience absolute bloodbaths on your timeline. Then listen up, because today we are tearing down the biggest illusion in the modern financial markets. Look at what is happening right now. Salesforce stock has literally been cut in half. Adobe is down 40% from its all-time high. Workday, Snowflake, MongoDB, Octave, all of them are bleeding out behind the woodshed like absolute garbage. 5 years ago, these exact same software companies were the untouchable darlings of the entire stock market. Everyone told you that you could not buy them because they were way too expensive, and now that they are being aggressively tossed to the side of the road, like historical relics, Wall Street is suddenly convinced that artificial intelligence is about to step in and finish them off forever. But before we dive into this massive sector wreckage, I need you to do one thing right now to prove you are committed to your own financial freedom journey. Drop a comment below with your exact age and the precise dollar amount you are realistically committing to invest every single month through your brokerage or your Roth IRA, even if it is just $50 or $500, because building wealth is entirely about discipline and long-term consistency. Type it in right now so we can hold each other accountable as a community, because the true secret to generational wealth is time in the market and never trying to time the market like a gambling degenerate. Now, when Mr. Market panics this loudly and this violently about this many giant companies all at the exact same time, he is almost always doing one of two things. He is either correctly pricing in a permanent corporate death sentence, or he is accidentally handing patient long-term value investors the absolute financial opportunity of a decade. In this video, I am going to show you the one single question that instantly separates these two extreme scenarios, and I am going to walk you through a real-world software example trading on the stock market today where the underlying fundamental numbers are frankly too ridiculous to believe. So let us talk about it like real adults over coffee before you touch a single stock or move your cash around. You absolutely must understand something that 99% of retail investors get completely wrong. Not all market sell-offs are created equal. You guys, there are 3 entirely different types of sell-offs, and they each demand a completely different mental response from you. Type 1 is what we call a company-specific sell-off. This happens when management completely blows a strategic decision, or corporate growth is visibly stalling, or some internal accounting fraud suddenly surfaces. When this happens, the individual stock drops, and the massive drop is usually 100% deserved because the underlying business is actually fundamentally worse today than it was yesterday. For the long term, Type 2 is a broader market-wide sell-off. This happens when macroeconomic interest rates spike, or a major global bank suddenly fails, or market liquidity completely evaporates, and absolutely everything gets aggressively repriced downward at the exact same time. During these chaotic macro moments, the good businesses, the bad businesses, and the completely ugly businesses all go down together in a screaming heap. And these are the exact historical moments that Warren Buffett literally lives for, because legendary compounders go on an absolute fire sale right alongside the overleveraged junk. Now, Type 3 is the exact situation we are trapped in right now. An industry-specific sector sell-off. This is not just one isolated company, and it is not the entire broad market index either. Instead, one single entire industry is being severely repriced, simultaneously because of a massive narrative shift in the collective story of that specific industry. In my personal opinion, industry sell-offs are the absolute most misunderstood events in the entire history of modern investing. Why? Because in the absolute dead center of them, the stock market completely stops being precise about the actual intrinsic value of these underlying businesses. Geographic uncertainty is running rampant, and institutional investors on Wall Street cannot tell who the ultimate winners and losers will be over the next 10 years. So what do? They just panic and dump absolutely everything in the sector into the garbage. They dump the absolute best companies with indestructible economic moats. They dump the worst companies with zero earnings. Everything is treated exactly the same with zero precision, and that massive lack of precision on Wall Street is exactly where your personal wealth opportunity lives, right there. That is where the deep gap between current stock price and true business value blows wide open for the highest quality companies in the sector. But you have to know exactly what to look for, or you will get absolutely slaughtered. Like everyone else right now, enterprise software is absolute ground zero. For this exact phenomenon, artificial intelligence has created a massive wave of existential panic across every single software as a service business on the planet. Retail investors and nervous analysts are screaming, will AI completely replace this software product? Will corporate pricing models totally collapse? Will customer growth permanently flatline? And rather than actually sitting down to answer those difficult questions carefully, one single company at a time, the market just decides to sell everything. So here's the one golden question I promised you at the top of the video that will tell you whether a fallen software stock is a dangerous value trap or a hidden treasure chest. Is this technological disruption structural? Is it temporary, or is it completely irrational? Making that distinction is absolutely everything if you want to protect your capital. Structural means the long-term earning power of this enterprise is permanently lower. The economic moat is totally broken, and the core product is guaranteed to be replaced by superior technology. Think about Kodak when digital cameras finally arrived. That was not a temporary dip in Kodak fortune. That was a corporate funeral because it was a permanent structural change. And when that happens, Mr. Market is 100% right to punish the stock. And a cheap price today will look incredibly expensive a year from now as the company continues its slow death march. Temporary means the immediate macro fear is incredibly loud, but the core economic moat is actually completely intact. In other words, corporate revenue and net earnings will take a quick bruise for 12 or 24 months, but then they are going to completely recover, and the company will come out the other side of the storm significantly stronger because their weaker competitors completely vanished during the crisis. Think about Texas Roadhouse during the global pandemic, when all physical restaurants were forced to close down completely. Their revenue temporarily vanished into thin air. The stock cratered to $35. And anyone who actually understood their deep cultural moat made an absolute fortune as the stock rocketed all the way up to $200. Now, the third bucket is irrational. This means Mr. Market fear is based on a pure emotional overreaction to something new and shiny in the industry. Remember when Netflix stock completely tanked from $66 down to $19 just because Disney and Apple decided to launch their own streaming services? Everyone screamed that Netflix was dead, and then it just turned out that the massive streaming wars did not actually destroy them, and the stock eventually shot up past several $100s. And that irrational bucket is exactly where I think we are standing today with a giant like Salesforce. Your entire job as a disciplined rule, one long-term investor in this current moment of artificial intelligence panic, is to sort each individual software company into one of those three precise buckets. Did AI cause a structural change, a temporary bruise, or a completely irrational sector repricing? If you get that one analysis right, you do not need to predict the future of artificial intelligence. You just need to recognize a durable economic moat when you see one. Let me make this incredibly concrete for you because I want to walk you through one specific company in this sector wreckage, not as a financial recommendation, you guys, but strictly as an educational example of how you need to train your brain to think. Let us look at the setup for Salesforce. Salesforce is the absolute central system of record for how the entire developed world manages its corporate customers. Global sales teams track every single deal in it. Marketing teams run massive automated campaigns out of it. And customer support teams literally live inside the software every single day. If you work in a mid-size or large global business, your entire corporate revenue engine runs directly through Salesforce. Now here is the ultimate fear driving the bears. Wall Street thinks autonomous AI agents will eventually match everything Salesforce does faster, better, and significantly cheaper. Or at an absolute minimum, AI will collapse the total number of employee seat licenses that companies need to buy. Fewer seat licenses means lower corporate revenue and totally crushed earnings. Now, that is the official bear case, and it is not entirely crazy on the surface. But here is what the legendary Charlie Munger would tell you to do. Invert, always invert. Instead of constantly asking how could Salesforce win, ask yourself what would it actually take for a competitor to kill Salesforce. To actually destroy them, a corporate customer would have to willingly rip out the entire central nervous system of their daily business operations. They would have to migrate decades of proprietary, highly sensitive customer data, completely retrain thousands of reluctant employees, rebuild every single complex software integration from scratch, and they would have to trust that a brand new AI agent that might hallucinate or stall or drop a critical record is going to flawlessly handle the core information that their entire corporate revenue depends on. Just picture yourself as a corporate vice president of sales who champions that massive software switch. What is your upside? If it works perfectly, you save a modestly small amount on your CRM costs. But what is your ultimate downside if the new AI system fails? You completely blow your quarter, you ruin your entire fiscal year, you maybe destroy your whole business, and you are for sure getting fired immediately. That massive risk is what we call an astronomical switching cost. And that is a true economic moat. Moats built on deeply embedded daily workflows do not just crumble in 12 months because a new technology arrives on the scene. At the absolute worst-case scenario, they tend to slowly erode over a decade or more, if at all. So here is the unbelievable disconnect between price and value that I mentioned earlier. Since its peak highs, the Salesforce stock price has been crushed, dragging its price-to-earnings ratio down from over 100 all the way down to a forward valuation around 22. A 22 price-to-earnings ratio on a dominant tech monopoly is insane. What that low multiple implies is that Mr. Market is expecting this giant business to grow at maybe 10 or 11% a year going forward. But look at the actual audited financial reality from their latest reports. Corporate earnings grew 20%, operating cash flow grew 16%, free cash flow grew 15%, and book equity grew 15%. Let that sink into your brain for a second. The stock is priced for an absolute funeral or 11% growth at best, while a business with deeply expensive switching costs is actively growing its cash flows at 15 to 20%. That is exactly what a massive gap looks like between market price and true business value during an industry sell-off. That is Mr. Market smelling imaginary smoke in a crowded theater that is not actually on fire while all the Wall Street lemmings are trampling each other running for the exit. Now, it is very important that you hear me on this. I am absolutely not telling you to go out and blindly buy Salesforce stock today. That is not what this video is about, and that is not how we play this game. There are still completely legitimate long-term questions about how AI will reshape the CRM landscape over the next 10 years. And you should always take the counter-arguments incredibly seriously. Charlie Munger said it best. You must know the opposing argument better than the people who are actually making it, and that is the #1 way you avoid losing your shirt in the market. What I am trying to teach you is a repeatable mental framework. When an entire industry gets violently repriced because of macro fear, your job is not to run away with the screaming herd. Your job is to look directly at the individual companies inside the burning wreckage and calmly ask 3 objective questions. #1, is the core economic moat still completely intact, or is it visibly breaking? #2, are the actual audited financials still rock solid, or are they actively deteriorating? And #3, is the current market price sitting well below what the business is actually worth, based on cash flows? And when all 3 of those fundamental pillars line up perfectly, meaning you get a real moat, strong growing financials, and raw emotional market fear dragging the stock price down to the pavement, that is exactly when you lean in. That is when you do the hard analytical work and make up your own damn mind instead of listening to talking heads on television. That independent mindset is the absolute key to this entire wealth game, because as Buffett and Munger have demonstrated over multiple decades, Wall Street has a funny way of making expensive witch doctors look competent. Their short-term emotional opinion is not automatically better than yours. In fact, since you have the unique luxury to think in 5 to 10-year periods or even entire decades, while institutional fund managers can only think about the next 3 months or they get fired, you have a massive structural edge in moments exactly like this one. Look, you guys, right now an entire tech sector is on a massive clearance sale because nobody on Wall Street has the patience to separate the actual winners from the future losers. And that is precisely why a disciplined long-term value framework exists in the first place. This is exactly when real investing earns its keep. If you want to learn how to objectively read an economic moat, or how to pressure test a corporate balance sheet like a professional, or how to calculate the exact intrinsic value of a business, so you can set your personal buy price with total confidence, or even how to safely use options to generate immediate cash flow while you wait for the market to recover, that is exactly what we teach inside our 3-day online workshop. Over 30,000 students have already gone through it, and the results speak for themselves. So go take a quick look at our 4.8 rating on Trustpilot, because the community feedback has been absolutely incredible. If that sounds like the exact financial skill set you want in your investing arsenal so you can profit the next time an industry sell-off shows up, because trust me, there is always a next one, then check the official link in the description below or simply scan the QR code right here on the screen. Thank you so much for watching, you guys. Now go play the long game, hit that subscribe button. Peace.